Welcome to this edition of Thought Leadership Bites. Today I have with me Mr. S. Naren, the Chief Investment Officer of ICICI Prudential Asset Management Company. Welcome, Naren.
Hello.
Yeah. So, Naren, we are having this shoot after a while, and during this period, global markets almost hit pre-COVID highs. Indian markets also, especially from an equity perspective, are almost, I think 5-6% below the pre-COVID peak. Where do we go from here, and what has been the cause of this rally?
The cause of this rally is very easy to determine. It is the US Federal Reserve. I think when the COVID-19 crisis broke out, the Fed actually put $4 trillion of money to work. And by putting $4 trillion of money to work, they ensured that all the asset classes in the world actually had a phenomenal rally, including all emerging market equity assets and Indian equities. So this has resulted in a very good rally in Indian equities. So we should all be thankful to the US Fed for actually making this rally possible. So I think we have to recognize this factor, and that is where and kind of frameworks helps us a lot in preserving capital. Because in March, when the equity markets were lower, it was wise to put much more money into equity markets. Today, as the market higher, it is wise to be careful, but at the same time, it is not logical for you to take out all the money from equities today. Markets can keep going up because it's difficult to predict the top of the markets. Markets can keep going up in a liquidity rally. It is wise to be careful to ensure that you don't say today is the top and take out money like many people are doing. And I would say that you have to ensure that you remain invested and only book profits gradually into this rally, and that's what we've been telling people.
What are the risks that you see going forward?
See, the risk going forward is political primarily, because the US Fed has committed itself to preserving liquidity for an extended period of time through many interviews that they have shared. So I believe that if they were to be given a choice, they would keep interest rates at zero for more than 2 or 3 years. And that would be very positive for Indian equities and other equity asset classes across the world. So it is only if something changes politically and that forces them to actually change the model, I would actually believe that liquidity is there in the world markets to stay. And even if politically things change, I believe that what would happen is that there would be a big fiscal push. And if there is a big fiscal push, that would mean that many of the value stocks in the world would actually see a big rally, because right now, if you look at the world, it has been led by a few growth stocks and FANG stocks that have dominated the rallies. And I believe that if you're going to have a fiscal push in many parts of the world, you're going to see many value stocks do well. And these stocks have done badly for the last 12 years. And that will lead to value stocks over the next few years. So I think it is wise to have a wide variety of assets in your portfolio at this point of time. And one has to also remember at this point of time that interest rates are much lower today than they were a few years back. And that is a factor that every investor has to remember at this point of time. Compared to what it was 2 years back or 3 years back, interest rates are not what they were, and therefore the returns that they can get, the returns that they can get in any of investing is much lower today than they could have got in the last 2 or 3 years.
A counter-cyclical investment process. Basically, 2 years back, if you look at it, we were talking about pharma. And today, banking and financial services as a space while the overall market has gone up, led by IT, pharma, and maybe consumer staples and so on and so forth. In Indian context, as the largest company in India for that matter. But banking and financial services space is still 20 to 30% lower than where it was, and the perception about it continues to remain a little bit, I would say, somber. So do you think that is a space which is looking now attractive from a long-term perspective?
Absolutely. I think if I look 5 years from now, I think the outlook for the top 5 banks in the country will be very, very positive. And therefore, whenever we have a situation where the long-term outlook is good and the near-term outlook is not that clear, we have always recommended SIPs and STPs in that asset class. We think this is the time to actually invest in SIPs and STPs in banking fund over the course of the next 1 year or 1.5 years, because I believe that banking as a team has underperformed significantly, and therefore it actually suggests that time to do SIPs and STPs in banking as a team. Just like about a year back or year and a half back, both small cap and pharma actually recommended itself to that area. And today, small caps and pharma have delivered phenomenal returns. In the last 3 months, small caps have delivered 30% and pharma has delivered more than 50% returns over a 1-year period. We think that banking as a theme can be considered for SIPs and STPs at this time for long-term investments. And that's clear at this point.
So one of the challenges which you alluded to also is the fact that globally there is no yield left now. In Indian context also, maybe if inflation is 4-5% and a AAA short-term bond portfolio is also offering around 5%, and for that matter, pretty much high quality risk-free spaces in that in that order. So what does one do to generate some real yield from a fixed income perspective?
What we've been recommending is that go into moderate duration products and also consider products which can invest in AA categories, because AAA funds which only invest in AAA securities are yielding very, very low yield to maturities at this point of time. And that is the reality at this point of time. That is the reality globally at this point of time. The 10-year US Treasury, the G-Sec today yields only 0.55%. And that is a big challenge at this point of time. And that has resulted in a situation that there is going to be a rush for yields over a period of time. And the time to invest in moderate duration AA paper is today, in my opinion.
Last point, Naren, I think there is a significant amount of interest that has come up in gold. And gold, like in 2010-11, is making kind of one-way up move, led by maybe dollar kind of weakening, all real interest rates down, and so on and so forth. It is also said that dollar on inflation-adjusted basis hasn't yet crossed the 2011 peak. Right? So to that extent, there could be 5, 10, 20% upside also still there. Do you think that maybe the 3-month, 6-month out will be okay from a gold perspective, but one has to kind of really take a very long term when one is considering exposure to gold, because the medium term could be volatile?
Gold is a bet against the US central bank, for example, or a bet against dollar. So if you think the US interest rates are going to go up significantly or going to go up back, I think gold will do badly. Otherwise, today people are buying gold because US interest rates are just going down, down and down. It's a very difficult asset globally, but you have to remember in India, we've been buying gold for centuries. As a country, we have one of the largest treasure troves of gold. And for us, whether we need to put money in AA debt or gold, because just today I was reading that we have possibly 100 lakh crores of gold as Indians. We don't have even 20 lakh crores of assets in mutual funds. So, do we need to invest in gold or we need to invest in mutual funds? Is a question that I would like to ask all the investors. So that's why I keep telling people invest in AA debt funds, maybe over gold, because we already have 100 lakh crores of money in gold. And but having said that, if a dollar continues to do very badly, gold is the alternate asset class, and clearly I would say that gold has always done well whenever dollar has done very badly. That is something which I can clearly tell you, but I would recommend investors to consider AA debt, because Indians as a citizens are not underinvested in gold. For a period from 2010 to 15, I would say, or till 13, they kept investing large sums of money in gold. So I think point of time, why should they continue to invest large sums of money in gold today is my view. But this is more my personal view, and gold is always a personal view, because end of the day you don't have interest rates, you don't have dividend, and how to determine cash flow of gold is a conundrum for everyone from Warren Buffett to everyone who connected with investing.
To conclude, what you're saying, Naren, essentially is that with equities, it's a global rally that has happened. Be prepared for some medium-term volatility around it, but the long-term outlook looks good. From a debt perspective, it's important to kind of look for some risk-adjusted yield related to inflation as well. The AAA high-quality stuff doesn't offer that kind of yield anymore, and could be in fact susceptible to some mark-to-market risk also. And with gold, like you said, that while one doesn't have to kind of over-invest, but the long term might not be as problematic as one would kind of be apprehensive about, right?
Absolutely. I believe that it's very important to preserve asset allocation in such volatile periods. It's important to be very disciplined in such periods when markets are closer. And the people who have been disciplined when markets are at highs have always benefited. And that is what I guess ICICI Bank Wealth has always tried its best to ask people to be disciplined. And there is never an easy way out to make good long-term money. And the risk when the markets are higher than the risk when the markets are low.
And the last piece is, you think that there is an opportunity which is opening up in banking and financial services as a space from a long-term SIP?
Absolutely. Long-term SIP and even STPs over the next few years is something that clearly, I believe that whenever any asset class underperforms for a period of time, I recommend SIPs and STPs in that asset class, particularly STPs. SIPs you can do in any asset class for a long period of time. STPs for the next 2 years is something I would recommend in banking.
Thanks, Naren, for your time. I think this should be useful for our viewers and investors. Thank you.